Now we get into derivatives. I'm a big fan of derivatives. Used a lot of them in my job at USAA. Very powerful things. So let's talk through them. Let's understand them from a theoretical side, and then actually get into some calculations to see how they work mathematically. There's a lot that you can do here on your own. There's plenty of YouTubes out there. Even the Khan Academy has a series of YouTubes on options. A good place to go, I think I have some links down here below. The cboe.com has some resources, some online tutorials, some blogs, some podcasts. Khan Academy, as I mentioned. This book, Options as a Strategic Asset, I have not read it, haven't used it, but I do think it could be a good book. I should get it since I'm recommending it and see how good it is. But you have to be careful with books on options. They tend to be focused on option pricing, and I think you're much better off focusing on option strategies. Option pricing is important to know and to have done. Have worked through it, whether it's the binomial model or the Black-Scholes model or other models. It's important to understand them, but ultimately it's strategies that you're after. And here's a strategy. This book, I highly recommend this book. Really, really good explanation, really, especially after doing paper 2, because it's talking about trading on corporate earnings news. It's what you just wrote your paper 2, what you wrote your paper 2 on. And it's talking about a straddle strategy, and we'll talk about straddles. But it's a strategy of using options to take advantage when a firm reports earnings and trying to take advantage of that large stock move. So interesting book. Boy, I don't know why a used book be 130 bucks. These prices are really overpriced. So don't spend that kind of money. Get it on Kindle or get it Audible if they do have Audible. It doesn't look like they do, but yeah, don't spend that. It's not that good of a book. Boy, that's amazing. I don't know why. Someone must be using that as a textbook now. The options guide is really, really good. You can see most of these are related to options. And we'll talk about why it's more related to options than it is to futures. But the options guide has a lot of the strategies we're going to talk about. We're going to talk about covered calls. We'll talk about protected puts and some of these others that are in here. Put call ratio. We'll talk about put call parity. We probably won't get into put call ratios, but they're fairly easy to understand. All kinds of things in here that very, very interesting. It's a lot of good graphics once you get into the strategy. So in covered calls, they'll do the graphs just like we're going to do. We're going to draw these graphs. I'll show you how to do them in Excel. So there's a lot there that you can work with. Their podcasts on options and futures and other things. So here's one option. Here's one set of podcasts on options. I've listened to some of these. I haven't gotten into them too much, so I can't say how good or bad they are. But I've had some students use them and found them really, really helpful. So there's plenty of resources. My word, you can definitely. There's classes that you can take. UTSA does have a speculative markets class. I took it with Dr. Misra as a graduate student. Actually audited his course, and so. Yeah, I do recommend you take. I don't know who's teaching it now and how often they actually offer it, but you can teach yourself. You don't have to be in a class. There are things you can do. We have an alumni, a guy named Eric Moss, who was in this class, investments class. I need to get up to Chicago and meet with him once this coronavirus is past us and see what he's doing. He's probably way over my head by now. He's graduated a couple years ago and very heavy into option trading, working in Chicago, which Chicago's right there near the Chicago Board of Option Exchange. So I'd be curious to see what he's learned, and maybe he could come back and do some sessions with the students at UTSA. But yeah, it's a great area to really learn. It's a powerful, powerful tool. So let's figure out what is a derivative. So you see the word derive in there. A derivative is a security that derives its value, how much it's worth, is based not on its own fundamentals and its own cash flows, but it's based on something else, another security, It can be based on a benchmark, an index. It can be based on inflation, economic. There's almost no limit. There's a great book, and I should add it to my reading list. I just haven't gotten around it, but it's a man who's writing about creating these new derivatives and what they went through to create a new derivative. He talks about trying to create an inflation derivative and the struggle he had doing that. They've done weather derivatives that are based on how much it rains or how much sun there is. I mean, they've gone crazy, and he talked about when derivatives that were brand new actually worked and they had a market, and when they didn't work and they didn't have a market. Very interesting stuff. So the thing that it's derived from is known as the underlying. It's that underlying security or benchmark or index or whatever it is. What is that underlying that gives a value to the derivatives? So if you buy an option on Apple stock, and we'll talk about call options and put options. If you buy a call option on Apple stock, then the call option will derive its value from Apple, and Apple stock is the underlying security. And you need to know what is the underlying security, because that's really what you're betting on. You don't buy an option or a future because you think the option or the future is mispriced. You buy an option or a future because you think the underlying security or index is mispriced, and you're trying to take advantage of that. Now, the good news is there's really only two basic types of derivatives. There are options and there are futures, and that's it. There's nothing else. Those two categories. So options include things like swaptions. We won't get into those. I talk about them some in my risk management class. Insurance, when you buy auto insurance, life insurance, those are essentially options. We won't talk about them here. I'll talk about them in my insurance class. The right to prepay your mortgage. We talked about that earlier with mortgage-backed securities. Mortgage-backed securities are essentially, when you buy a mortgage-backed security, you're essentially buying a mortgage and you're selling an option on interest rates. So those are options, but there's actual options themselves. So the key with an option is that it gives you the right to do something. It doesn't require you to do something. You don't have to do it, but it gives you the right to buy something, or it gives you the right to sell something within some future date at some stated price. So we'll talk about the expiration date, the strike price, all those kind of things. That's the key with the option. It's in there in the title. It's an option. You don't have to do it, but you have the right to do it. Options always have value. It's always nice to say, hey, you have the right to do it, so you don't have to. So if you buy an option on a house, you have a right to buy that house, but if you change your mind, you don't have to. So you might spend $10,000 for the right to buy a $500,000 house. No one else can buy that house. You have the option on it. If the real estate market crashes and now you can buy the exact same house, but now for $300,000 somewhere else, you'll just let that option expire worthless at $10,000, and you'll go buy the house for another house for $300,000, and I'll have to pay $500,000. So that's very valuable to you. Now, was it worth $10,000 that you paid for it? No, maybe it's only worth $100. Who knows? But it's worth something, and so that's the key. The right to be able to do something has some value. Futures include swaps. Oh man, I love swaps. They're my favorite derivative of all. We did swaps at USAA. I really introduced USAA to swaps. Tremendous value to USAA, especially in 2008. We were doing options and swaps in 2008, and those two strategies saved USAA probably close to $2 billion. They're really powerful things. So I love swaps. I encourage you to learn about swaps. I cover them in my risk management class. I think Dr. Katapakam covers them in his class, and I'm sure if you did a speculative markets class, they would talk about swaps. It includes forwards. Forwards are essentially the same as futures. We'll talk a little bit about them. They're essentially the same. When I took the CFA exam, one of the books we had to read is maybe a 100-page book, and the entire book was to show that mathematically a swap and the future are the same transaction. I couldn't do that math today. It's been a long time since I read that book, but when I read it, I sat down, rolled up my sleeves, and I did the math. I did everything in the book, and boy, very insightful, very educational, but boy, I couldn't replicate it today. It's quite complex. So we won't talk about swaps here. I will talk some about futures, but futures, swaps, forwards, they require you to do something. They require you to buy or sell something in the future. Now, the nice thing about a future is that it doesn't cost, in a swap, it doesn't cost you anything today. They're essentially free. Now you may have to put some collateral aside. That's true. We'll talk a little bit about that. But the actual price is zero. It's a free security. Whereas an option is not free. You have to pay money for an option. I talked about that real estate option, paying $10,000 for the option to buy something. It costs you money. But a future, a swap, a forward, they're essentially free at the point of execution, and then their price moves around. They both have underlines. Options have underlying securities. Futures have underlying securities. But they behave very, very differently. There's some terminology we have to get. You might Wikipedia some of these terminology to see if you can find a better definition than I'm giving you here. Notional value is a really tough term to understand. So the notional amount is essentially the value of the underlying that your derivative is based off of. So if Apple's trading for, say, $500, I have no idea. I haven't looked at Apple in a while. Let's just look so I'm not using bad. I'll use Apple as my example in some of these. So 282. Boy, it's been a while since I've looked. That's kind of embarrassing not to know. Oh, sorry, where's my notes? So if Apple's trading for $300 and you have options on 100 shares, then your notional is going to be 300 times 100, or $30,000. That's going to be your notional value. Now that notional value is very important because it's going to definitely drive the value of your derivatives. Will definitely push that value around. So it's important to know, but you don't have a $30,000 investment in Apple. You have an option on Apple. You might have a future on Apple. Now notional amounts are really, really important because it's quoted in the press a lot. So if you ask what the outstanding notional value of swaps is, you'll see some crazy, crazy huge numbers. I don't see them here. Notional amount, I don't know if they'll give it to you. I've seen numbers that are 80 trillion or more. There's just ridiculously large numbers. So they look scary. They're scary numbers. Boy, I'm surprised I don't show his. Let's see, total swaps outstanding. I just want to see it if they'll tell us. Yeah, I can't get it. I've seen some that are bringing it up, so it's not showing me here. So yeah, but you'll see numbers that are greater than the entire economies of the entire world combined. They're massive numbers. They look scary. The media loves to report them, but that's not really what's important about notional value. The important of notional value is not how much you have. You're not exposed $30,000 to Apple. What it says is it's going to tell you how your derivative will move. It kind of gives you the size of the derivative. So if you have 300 shares of Apple, 100 shares of Apple times $300, your option is going to move based on a $30,000 underlying. But that doesn't mean it's going to move $30,000. It's going to move some other amount. But that just tells you that it's going to move half as much versus someone who has options on 200 shares of Apple and who has a notional amount of 60,000. They're going to have twice as much exposure, but it doesn't mean that they have $60,000 of losses or gains. That just tells you, that gives you what the size is. It's a really tough term to explain. I'll give you a few examples as we go through to maybe help it a little bit better, especially when we do the options. So it explains what your exposure to something is related to a formula. So you need a formula times that exposure that tells you what your gains and losses are going to do. It's not the market value derivative. So when I entered my first interest rate swap, I think the notional amount might have been $3 billion. So you say, wow, $3 billion, that's a lot of money. Well, but $3 billion did not go on USA's balance sheet. In fact, zero went on USA's balance sheet. The market value of a swap when you enter it is zero. But that swap is going to move as if I had $3 billion invested. So if that underlying moves 10%, my market value is going to move $300 million because I have a notional value of $3 billion. If that notional amount moves 10%, my swap is going to move $300 million. So if the notional amount goes from $3 billion to $3.3 billion, it moves up 10%. My swap will go from $0 to $300 million. And so it tells me what I'm going to gain or lose. It's pretty important stuff. So if you go long on futures on the S&P 500 $1 million, then your market value on that future when you enter it is zero. Your notional amount is $1 million. If the S&P rises 10%, the market value of that future will increase $100,000. It will go from zero to $100,000. That interest rate swap I did at UTSA, we entered it at zero. Its market value was zero. And a couple years later, it was worth $516 million. So it went from zero to $500 million in a few years based on the underlying notional amount of that swap. So they're powerful things. If you can go from zero to $500 million, it's a powerful thing, but you better know what you're doing, because if you don't know what you're doing, it could go from zero to negative $500 million, and then you have massive losses for your firm. The underlying, that's what it's all based on. We said for if your option's on Apple stock, then it's on Apple. So the underlying is what is that thing that it's applied to. It could be a specific stock like Apple. It could be an exchange traded fund, which opens up all kinds of interesting trades. We may talk about a couple of these because I think it's pretty amazing. Could be on an index like the S&P 500 index. Could be an option on or a future on commodities. In fact, commodities are traded quite frequently using futures. If you buy an exchange traded fund on oil or on gold, most likely they're creating that ETF using futures and not actually buying the oil directly. Swaps are essentially futures on interest rates, on inflation, on currencies. Obviously, interest rate swaps and currency swaps, that's a huge transaction, trillions of dollars around the world. And then other things like weather, catastrophes, life insurance. We have these new things called social impact bonds that are derivatives based on underlying success rates of cities or jails or whatever thing. And we're getting pretty creative in finance to create these derivatives. And that's why I recommend that book, the gentleman who talked about what derivatives work and what derivatives don't work. Very interesting stuff. If you can make your entire career out of just picking a specific type of swap or future or option and doing that for the rest of your career. That's why I'm so interested in talking to Eric Moss and seeing exactly what he's doing in this field. My option trader at Credit Suisse, a guy named Stuart, boy, that's all he did, and boy, he knew that stuff so extremely well. Very exciting. I'm trying to get him to come to speak at UTSA one of these days. All right, so next session we'll get started with futures and learn about them. I'm not a big fan of futures. I love swaps. I don't like futures. Futures and currencies are just one area of finance my brain just doesn't like. But I'll talk about futures. I will not talk about swaps in this class, but if you take my risk management class, we definitely get into swaps pretty heavily. I love swaps. They're very, very powerful things, and to me, they just make more sense than futures. But I'll do my best to walk you through futures so you can understand why they're such a powerful force in finance.